All right, for our final segment, we're going to go through some of the optional practice. So down here in chapter 3 of module 2, we're only going to do about half of them or so. We're going to save the other half for our next class session. So this chapter 3, even though in the course here they do it all as one, we're going to kind of break chapter 3 into 2 parts. Otherwise, I think it's just too much information. So this is where I'm at. I'm in the optional practice. We're going to, like we did last time, we're going to skip past this first one because it's really long and it has a lot of different parts. We're going to do some smaller segments to kind of get an idea of how this works in the software. We're not going to do every problem. We're going to do some of the ones that I think are similar to the homework. All right, so this first one here, we're talking about our employees and they have worked, but we haven't paid them at the end of the year. We're going to pay them later. So that's what this first thing is going to do. The key thing here is we don't want to get tripped up on any of the amounts. Notice that they have 5 employees and each earns $250 a day. So it's not $250 total for a day, it's $250 times 5 because we have 5 of them. That's the first thing to where a mistake could be made that we don't want to do here. All right, so they are paid on Fridays of that same week. So they work Monday through Friday and then they are immediately cut a check on Friday afternoon and they're paid. However, the year end falls during this week. It actually falls right after Monday. So they work on Monday and then they work January 2nd, 3rd, and 4th for 3 more days during the week. And what we need to do is update their books at the end of the year and then show what the payment is. So we're going to take it the next step and we're going to show what the payment is at January 4th. All right, so on December 31, our employees worked, so our debit has to be wage expense because we got the benefit of them working. And the credit needs to be, usually it's cash, but not in this case because we don't pay them on Monday. So we need to show wages payable. So our debit here would be wage expense. And we don't want to put $250. I actually want to take $250 and then multiply it by 5 because we have 5 employees. So $12.50. And then show that this is a wages payable because I'm not actually paying them yet. Now, it might help if off to the side you had a little T account going. You don't need to. This isn't too hard to remember. But we're just going to need to remember that we do have a wage payable going into the next year of $12.50. If you don't think you can remember that, then we'll want to make a little T account off to the side on a separate sheet of paper. On even a T account sheet. So we record that entry. And now we need to show what would the entry be on Friday, January 4th. So on Friday, January 4th, we actually pay our employees the full amount for those 4 days that they worked because they didn't work Tuesday, the holiday. They worked Monday, Wednesday, Thursday, Friday. So if we figure up the total amount that they earned, the $12.50 was for Monday, and then if we multiply it by 4 days, they actually earned $5,000. So I'm going to be writing checks that total out to $5,000. So that's going to be a key number. That's going to be our cash. That's going to be our credit cash. We just need to figure out how we got there. Well, how we got there is the first thing is our employees worked during January. They worked 3 days worth. We know that 1 day was $12.50. And if we do 3 days, that's $37.50. So our employees worked $37.50 during the month of January, during this current year. But I didn't just pay them for this month. I paid them for a little bit of last month. And this is where we just needed to remember that last month we still owed our employees $12.50 as a wages payable. So I need to now get rid of that because I'm paying that off. And then finally, I need to show that, yep, I am paying everything off for a total of $5,000. And then I want to just check my work. Everything looks good. All right, let's look at this third one, number 3. We're going to do some different entries. We're going to do the adjusting entry at the end of April, and then we're going to show that the payment was done in May. So these are where work is done now, but then payment is done at some point in the future. So this is one of those, these are accrued accounts basically, if you recall back to our segment 1. All right, so on April 1, the company got an attorney for $3,500 for the month of April. He did work for us, and then we actually paid him on the 12th. So this one's not that hard. We just need to show that during the month of April, we got the benefit of legal services. So just simply debit our legal services. And then our credit, why did we get the benefit of legal services? Usually it's because we pay for legal services, but we didn't yet. We're not paying until next month. So that becomes a liability. We owe $3,500 of legal services. Now, when May 12th comes along, we actually write a check for those legal services. So we no longer owe the legal services. So the question then, our debit question, what did we get? Well, we got a reduction on what we owe. We no longer owe $3,500, we owe nothing because we paid it all off. And to show that we paid it, we need to credit our cash for $3,500. Okay. Now, what this is telling us is we have a really large note payable, something that's going to be paid off over a long period of time. That's what a note means. 12% annual interest. We haven't really talked about, nor does this problem expect you to figure out how to calculate interest. So they go ahead and tell us that the interest is $9,000 every month. That's a lot. That's a lot of interest. $9,000 a month. And the interest is paid on the 20th of every month. So we just made the payment in April 20th. Now comes April 30th, the end of the month. I've accrued more interest. I've accrued 10 days of interest, or a third of the normal month. So a third of the 9,000 is 3,000. So I need to show that as of April 30th, I have accrued some interest. From April 20th through the April 30th, even though no payment was made, I still now owe 3,000 more of interest just in 10 days. That's a lot. That's $300 a day. Now, I'm not paying the interest right now in April 30th. I'm going to wait till May 20th. So that means that I have to set up an interest payable account, just like a wages payable. 3,000. Now, off to the side, we're going to need to make note of this. You even have a little T account set up that shows I owe interest in the month of May for 3,000. Now, when we come to the May 20th, I'm ready to make a payment, another $9,000 payment. Well, part of that $9,000 came from April. April said you owe $3,000 for the end of April. Okay, good. But I also owe now May 1 through May 20th interest. And so current interest is called interest expense. So interest expense for the month of May is $6,000. And altogether, I'm making a payment of cash for $9,000. And that has nothing to do with anything on the loan. So the loan is still $900. I didn't make, with just this problem, nothing is gone to the loan. All I'm doing is just paying the interest. That's not very good. My loan did not go down. And then this last one, this one is just like the one we just did with the wages. So we're just going to, hopefully you can get this one without much help. The weekly salaries is $10,000, paid each Friday. April 30th falls on a Tuesday, so that's the second day out of the week. So we've got it, if the total payday is $10,000 over 5 days, if you just do the easy math there, that's $2,000 a day. So on April 30th, instead of showing wages expense of $10,000, because it's not really, they're going to call this, instead of wages, I don't like it when they change the name, because if you just type in wage expense, nothing shows up. On the other one we did, we got to call this one salary expense. Our workers on April 30th have worked 2 days, the 29th and the 30th. So we need to show that they worked those 2 days since the last payment. And we need to show that we owe them money for those 2 days because we haven't paid them yet. We're not going to pay them till May 3rd. This is the one we want to keep note of, the April wages, $4,000. Because when May 3rd comes, we are going to pay them the April wages, salaries. We're going to pay them the $4,000 from April. We're also going to pay them for the 3 days of work in May. That's $2,000 times 3. And then we're going to write a check that totals 10 grand for the entire week. And let's check our work. And it looks good. We got everything correct. All right, number 4 is very similar. We're going to skip past number 4. You should be able to do this one. Notice here with the depreciation, they go ahead and just give it to you, and that's how they're going to do it, I think, on most of these problems. Where in our segment number 2, we actually calculated it. We took the price divided by the useful life to get our depreciation expense. They just go ahead and give it to you, so it's actually a little easier. This one on part C, they do it like how we did. Maybe we should go through this one. Yeah, let's just go through C, because this one's a little bit more involved. It kind of helps if you keep a little T account off to the side, and maybe I'll do that. I'll pull up an old T account. I think you'll find that will be helpful. You should always do that whenever there's anything that involves more than just something you can easily do in your head. Just pull up a T account. It makes it a lot easier. All right. So it says our supplies at the end of, because we're in 2017. So at the end of last year, our supplies had a balance of $700. So that is a balance, our opening balance. And then it says $34.80 were purchased during the year. So sometime during the year, we bought $34.80. And then I'm gonna put in a couple rows here so we can visualize what's going on. At this point, if we wanted to, we could go ahead and balance the account and see, well, what did I have? This is our kind of a summary. We'll just call it a summary. In total, I had supplies at $41.80. But it's saying after I actually counted them, I only have 300 of supplies left. So our final balance at the end of the year is only 300. So what I have to do is do the journal entry, the adjusting entry on 1231 to show what did I do? How did I get from 4180 in supplies down to 300? Well, I had to get rid of some of the supplies. I started using them. And then it's just the difference here between these two amounts. 4180 minus the 300 that's left means I used 3880. And then if I used it, that's an expense. I get the benefit of supply expense for 3880 and credit my supply account to show that I lost 3880 of supplies. Let's see if there's any other harder ones. All the rest of them, I think you can get. All right, so let's go on. Number 5 is very similar to number 4. I think you should be able to get those. So this is just a lot of practice if you want to keep practicing. All right, number 6. This one is a little tougher, so we're going to go through this one. Number 6. So what they've given us over here on the left is an unadjusted, basically part of the trial balance. It's really the income statement because it's only the income statement items, but you could kind of think of it like a trial balance in a way. But it's an income statement. This is before the adjusting entries, what our income statement was. And then we did some adjusting entries to get all of our T accounts up to date. And this is our new thing. So you can see that some of the numbers definitely moved. Revenues went up $7 grand. Depreciation went up from 0 to there. Our salaries, they went up. So what it's telling us to do is by using these, we need to mentally think about what probably happened. It says, do the 8 adjusting entries that were likely to occur to get to the amounts that they're at. And it does tell us here one note, one thing that we have to know before we can finish this. It's saying when you look at these fees earned, there's a $7,000 adjustment. Well, that $7,000, it's telling us, came in 2 different ways. First, it's saying that we need to show that we actually billed our clients for new work that was done. We need to put that into an account receivable. And it's saying the other piece, the rest of that $7,000, was actually unearned revenue that we previously had that we've now done. Okay, so let's do this. It says we're going to do these, and you count them up. You're like 8 journal entries. I don't see 8. If I count up these letters, that's only 7 letters. That's because they're breaking A down into 2 parts. So we're going to do A in 2 parts. Part 1 of A, we're going to do this part first. Out of the 7,000 difference, we're going to just do this. That says out of that 7,000, 2,100 were fees that were earned but not yet actually sent out to the clients. So we need to go ahead and send it out to the clients. We need to do an account receivable for the 2,100. That's what I'm getting, a promise to be paid. I'm getting a promise to be paid because, and you got to use the right words here. You can't use like, if you use service revenue, nothing's going to come up. If you use sales revenue, nothing's going to come up. On this one, you got to use fees earned. And fees earned was 2,100. And you can know to use fees earned because that's the account that they use here, fees earned. So that's entry A1. Now A2, the other side of that, we need to now account for the 4,900 that gets us up to 7,000. It was finally earned from people that had paid in advance, like gift cards. Think of the gift card examples. So that's the unearned revenue. People had unearned revenue of 4,900 in a balance before, but now they don't. because we've now done the work. So what we got was a debit to our unearned fees. We no longer owe anything. Work done, so $4,900, and we don't owe it because we actually did the work. It's not unearned anymore. It's actually fees earned. It's earned fees. And I'm going to record that entry. B and C are going to look identical or almost identical. The only difference is this isn't common. Usually when you're looking at an income statement, the depreciation expenses are combined into one expense. There's no need to separate out the two of them. But for this problem, they do have you do that. So we're just going to do B all by itself. And B, it says we went from 0 to 1,600. So it only makes sense that we need to do a debit for depreciation expense for the computers for 1,600. And then back to our previous part 2 of our lecture said, remember, depreciation expense and accumulated depreciation always go together. And we want to pick, in this case, the computers. This one, the accumulated depreciation for the computers, that one we do need to keep separated out always, no matter what the problem is. It's the depreciation expense, the ones that go away at the end of every year, that we don't need to necessarily separate, but this problem does it. Let's go ahead and get part C done, and then we'll look at the next one. All right, C, 1850. It went from 0 up to 1850 for the office furniture. So we're going to do depreciation expense, office furniture, 50, and then accumulated depreciation for the office furniture, 1850. Now, for an adjusting entry, we've got to think, why would our supply expense go up from $13,500 up to $15,750 if it's for an adjusting entry only? If it's for an adjusting entry, that means cash wasn't involved. So we didn't pay our workers, but yet we still recorded work done. If work was done and we didn't pay them, then we owe them. So the journal entry that had to have happened, first we need to figure out what the difference is. And if you do that math, if you can do it in your head, that's $2,250. So we have a wages expense of $2,250. And then if we didn't pay him, if this was an adjusting entry, then it has to be a wages payable for $2,250. Now E, insurance expense. Insurance expense went from 0 up to $1,400. So if my insurance went up, and this is an adjusting entry, meaning I didn't pay it, I must have paid it at some other time, then my insurance expense must have probably came from my prepaid account. So what I'm going to do is show that my insurance went up by $1,400, my insurance expense, and where it probably came from, because usually you have to prepay insurance, is a prepaid account. So we're going to have insurance expense for the $1,400, and insurance is almost always prepaid ahead of time. So we're going to credit my prepaid insurance for that $1,400. Okay, the next one is F. F was office supplies expense. Our supply expense went from 0 to $580, so we used $580 of supplies. So we can show that we increased our supply expense by $580. And where did that $580 come from, those supplies? They came from our actual supply closet. So we're going to credit our office supplies and show that those went down by $580. So this account with the expense on the end shows that we've actually used it. And this is where it came from, like our supply closet. This one is going to be just like the utilities expense. These are probably prepaid, and so it's going to look just like our insurance expense. Let's go ahead and finish out then. Our utilities, we're at 1245. So utilities can be a lot of, well, let's think here. Utilities usually aren't prepaid. So no, it's not going to be just like the insurance expense. Utilities are usually billed out once they know how much you've used, because otherwise they don't know how much you're going to use ahead of time. So that's probably one that we're going to have to pay later. So that's going to be more of a utility payable or an account payable. We just got to figure out how much utilities did I use. If we go from 1335 minus where we started, that's $90. So I'm going to come down here and show that my utilities expense went up $90, and my utility payable, $90 at the end of the month or the end of the year. Go ahead and check the work. Oh, we missed this one. This one I'm gonna guess is supposed to be salaries. Yeah, salaries. I put wages. Wages to me and salaries are the same thing. So that would be the only one we would need to go back and correct. So I didn't pay good enough attention. When we do it in class, I count either one, wages or salaries or something even close. So we would just come in here and put in salaries expense, the wages, and salaries payable. And then if we check the work, it should be good. Yeah, that's what I wanted. This one, pretty similar to what we've already done. All right. Yep, this is going to start our final, what we're going to do next time. So we're going to start up here on number 8 and work way through a few more. We're going to kind of put everything together on our next class session. We're going to do our closing entries, close out the books for the end of the year, get our expenses and revenue down to 0, and then kind of do full circle and come back to what we did the very first day when we did the financial statements. That's where we're going to start here and finish up our financial statements. So with that, we will close out and we will finish chapter 3 on Wednesday. Thanks for watching, and I will see you guys soon.